Well, thank you. Thank you very much. For a few minutes there, I thought I was going to be like in one of these Texas country western bars where, they have the greats in front and the singers are singing and everybody's just having a grand old time and throwing the beer bottles at the singers. But, well, we'll see. We'll see how it goes. You may still want to do that. But thank you, the folks at the CFA here, for inviting me to speak, and that's Sean and Brady. Very nice of you to think of me. And at first I was thinking, well, do I really want to come out here in the middle of the winter? And then I had another invitation in Des Moines and some meetings in Chicago, so I put it all together, and I brought nice weather. So until now it's getting cold, but as it turned out, it was snowing in Chicago at O'Hare, so I couldn't go yesterday to O'Hare, so here I am. But again, thank you for the invitation and thank you for the nice weather. In Des Moines, I spoke to a group of people who invest in farmland, farmers and farmland, people that are looking at farms and in investments. So I learned quite a bit at the dinner over there. I sat between two Fed governors, Esther George and Tom Honig. Very, very nice people, and obviously diplomatic about it, but very upset about the attack of the administration on Jay Powell. I think a lot of people in the financial community don't really understand why this was necessary. But look, we live in tumultuous times. If you've remember your American history, you're continuing to study it, it's always been tumultuous in the United States. As a result of that tumult and as a result of all the craziness in Washington, there are a lot of commentators who tend to be fairly pessimistic when they see all the shenanigans that Washington is prone to. And I've been doing this for over 45 years, and what I've learned over the years is that it's amazing how well the U.S. economy has managed to do, and as well as how amazing the stock market has managed to do despite Washington. The reality is all of us working stiffs are doing the best we can to make our businesses better for ourselves, our families, our communities, our country. And we do that knowing that Washington, more often than not, is an impediment to what we're trying to achieve. And yet somehow or other, we manage to factor that into our business plans and succeed extremely well. So I think we do well despite Washington. And that helps me calm down about a lot of issues that are out there. There's issues of debt, partisanship, a lot of the issues that Washington raises. And the result of that, I've tended to be an optimist. I don't know, maybe I had a happy childhood. Maybe that's why I got along with everybody in the playground. But I think that when we look at the financial markets, and I think we got a chart right behind me, that's the S&P 500 going back quite a few years. And it's amazing how even though we don't spend a lot of time teaching financial history, everybody seems to know something about the 1920s leading to the 1930s, and that there was a terrible great crash, and in the 30s we had a depression. And there's still a lot of concerns that something like that could happen again, and it could. But the reality is it really hasn't, and the economy has continued to do quite well. Now, I blame Washington for what happened in the 1930s. We had a great environment in the 1920s. You might recall from history that right before the 1920s, there was a great war that ended a couple of years before the 1920s began. They called it the Great War because they didn't know there was going to be a Second World War, so it was called the Great War. And then the soldiers came back from the trenches and spread the Spanish flu. So we had a horrible pandemic during 1918 and 1919. And then in 1920, we had what was then described as a depression. Economists hadn't come up with this idea of a recession. Well, it's not so bad, it's a recession, it's not a depression. So if you were an economist or just anybody thinking about what was ahead, you couldn't possibly imagine that it was going to be anything good. You couldn't possibly imagine that it would be the roaring 1920s. And yet we had tremendous technological innovations, we had tremendous increases in productivity, and the economy boomed, the stock market boomed, and then, of course, in late 1929, the stock market crashed. But then it recovered 50% of what it lost, and it was back in April of 1930, it was back to where it was in April of 1929. What's the big deal? Well, then Congress and the president enacted the Smoot-Hawley tariff in May of 1930. And if you look at the stock market, you look at commodity prices, you look at economic indicators, they all crashed when the Smoot-Hawley tariff was passed. So it was a terrible tariff. It was a tariff that led to a lot of countries imposing similar tariffs. And I think it really instigated the Great Depression. There were other mistakes made by the Fed and other policy officials, but that was really it. So when I tell people that, 2020s, that kind of rhymes with the 1920s, let's think about the possibility that this could be the roaring 2020s. And I said that back in August of 2020. People said Yardeni's delusional. I mean, how could it possibly be a great decade given how it's already starting out with pandemic, with geopolitical tensions? And I stuck to my guns and I said, well, things started out pretty miserably in the 1920s. Why couldn't it turn out to be better in the 2020s than we felt at the beginning of the decade? And I argued that there was likely to be an increasing shortage of skilled workers, experienced workers. I have sort of an inside track on some of this because I'm a baby boomer, and I knew that a lot of my friends were starting to retire, and now more and more of them are retiring. And these people have a lot of experience, they're making a lot of money, but they're retiring. And the question is, are jobs going to be opening up for other people? And the other thing is the baby boomers were a boom. The younger generations weren't quite the boom. So I figured that there was going to be a shortage of workers, particularly skilled workers with experience, and that companies would rise to the challenge by using technology to increase productivity. And I mentioned things like AI, but I certainly didn't anticipate that AI would be the phenomenon that it's turned out to be since ChatGPT was introduced in 2022. And it's really not, it wasn't the heart of my story. The heart of the story was there are lots of technological innovations out there that will come together to allow companies to increase productivity. And I think that's worked reasonably well so far. We're already 6 years into the roaring 2020s. And for our business, clearly that can be summarized by what the stock market's doing. It's at an all-time record high. It's been roaring higher. And some of that is valuation, but a lot of that is earnings. The economy really has been surprisingly resilient. Now, I think I was just about the only economist on the street, and maybe in the world, for the past, back in 22, 23, who said, I don't think we're going to have a recession. And everybody else said, how's that possible? We had a pandemic. The pandemic led to a 2-month recession, lockdown recession. Well, that was a recession, but it was artificial and it didn't last very long. The Fed lowered interest rates dramatically. The lockdowns were eliminated. However, we all got cabin fever. We all wanted to feel better. And when we Americans, when we're happy, we spend money. When we're depressed, we spend even more money. And we saved all this money for a couple of months. And then we started getting checks. And we wanted to go shopping. It releases dopamines. It makes us feel really, really good. And the problem is we couldn't do it in services. The services economy still had not lockdowns, it had the social distancing restrictions. So we went on a buying binge for goods. And that exacerbated a global supply chain disruption, which led to inflation. And the inflation caused the Fed to raise interest rates from 0 to 5.5%. The bond yield went from 0 to 5%. How is it possible that we would not have a recession? It was logical that we would. And then last year we had all these tariffs, and people were adding up the numbers and said, this could turn out to be worse than the Smoot-Hawley tariff. So we've thrown all these shocks at the economy, and it just kept coming back and kept going higher. We had a bear market in 2022, lasted about 9 months. It was traditional 25% bear market, but there was no recession. Usually when people fear a recession is when you get a correction. If they fear a recession but it doesn't happen, you get a 10 to 20% drop. If they fear a recession and you get a recession, you get 25 to 50%. And that's because the PE goes down and the E goes down. In a correction, the E goes down, but people were wrong about the recession, so earnings don't go down. And so we had a recession that, we had a bear market fearing a recession. So we really have had the most widely anticipated recession of all times that didn't happen. Now nobody's talking about a recession, and the perma bears are out there. There's fewer of them, but there's a few vocal ones, and one of them, I'm not going to name any names, but David Rosenberg is a good friend, has been going around saying, nobody's talking about a recession, so it's going to happen. But you know David, he tends to be a perma bear. Now, I've been criticized the other way. People have said Yardeni is a perma bull. He's always bullish. And I view that as a compliment. I said, thank you so much for recognizing that, because when I die, on my tombstone, I wanted to say, Ed Yardeni was usually bullish and usually right. And I say, Exhibit 1. I'm not bragging. As a matter of fact, I'm pretty humble. And so I'm going to tell you something I don't really share too often, and that is I've had a great record of calling bottoms. And the reason I've had such an amazing record is I have a relative who I don't get along with very well. And when we get together for family gatherings, it's, hi, how are you? Other than that, we just really don't like each other. But at market bottoms, he always calls me up and says, Eddie, you know, we're real friendly all of a sudden. Usually people call me Ed, but Eddie, what do you think? Should I get out here? So I'm sure a lot of you have relatives like that, and you should love them because they're going to tell you when the market bottoms are. The perma bears, they'll get you out at the top. They'll get you out at the bottom. They'll get you out in the middle. You'll never invest in stocks if you listen to the perma bears. Now, to what do we owe this resilience of the economy that we've had? And by the way, the last really legitimate, horrible recession that was caused in a fairly typical way by tight monetary policy, speculative bubble bursting, was the recession of 2007, 2008, 2009. That was a really ugly one. We had sort of a garden variety bear market until September, when the government decided, mostly for personal reasons, they didn't like the head of Lehman, and they decided to pull the plug on Lehman. The next day, they bailed out Goldman and Morgan Stanley. So they could have bailed out Lehman, and things wouldn't have turned out to be quite as ugly as they turned out to be. By the way, speaking of that environment, the stock market on an intraday basis got down to 666. I remember I was in Princeton, New Jersey with Merrill Lynch as an account of ours, and we came out and the trader said the market just hit 666. I said, that's the devil number, you know, and it took me a couple of days. I said, I think that intraday 666 was the low. We went to hell and decided to get the hell out of there. And of course, the Fed lowered interest rates, and the Fed came in with basically a QE program, QE1. And so about 10 days after the 666, I said, you know what? I think that's the bottom. And I said, I'm not saying it as a strategist. I'm saying it as a symbolist, like Tom Hanks, you know, the Da Vinci Code, 666, that had to be the bottom. Anyways, it worked, but I was also obviously looking at what the Fed was doing, so the other reasons to believe. So that was kind of the last terrible recession, and we've thrown all of these shocks at the economy, and yet it's continued to perform pretty well. And, oh, I pressed the wrong button. There we go. And it's done well because earnings have basically been very, very strong. This is reported earnings going all the way back, as far back as we can get it. But it's really been a huge earnings story. The reality is we've got some of the best managed companies, businesses in the world. They've been through a lot. They've learned how to negotiate, manage their businesses through thick and thin. They know how to deal with Washington. They know how to incorporate what Washington's doing. And they are laser focused, I think, on the profit margin. Obviously, people in business do focus on getting bigger market share and doing other kind of things that hopefully will make you more profitable. But they really, I think, have been focusing on the profit margin. And I think increasingly they've been using technology as a way to improve the profit margin. So the resilience of the economy can be explained in a few ways, for a few reasons. One of them, and again, I have an inside track as a baby boomer. I see all my friends retiring, and I go to the Fed data on net worth of households, and I see that the baby boom generation, they've got the net worth of households broken up by age of the householder. And so the baby boom generation is sitting on $85 trillion of net worth, not billions, trillions. Let's see how far I have to go. None of these things are relevant, so we'll skip them all. But I'll come back to them, some of them anyways. This is it. I mean, you look at the blue area. In the blue area, I started working at the Federal Reserve Bank of New York. I was there for about a year. I started working there in the late 1970s, early 80s. I was getting $21,000 a year, which even back then wasn't a lot. But I had a one-bedroom apartment on 69th Street between 1st and 2nd. It was a tiny little thing, but it was $400 a month. Now you can't get a parking space for $400 a month in New York City. So there was no affordability crisis back then. There was no being stuck with student loans. And there was a mentality of you get a job and you rise in the company. You start out with no title, then maybe AVP, then maybe VP, then SVP, then EVP. By the way, when you explain that to young folks today, said those some sort of new cryptocurrencies, because they don't have that culture of rising within the same company or even deluding yourself that you would work for the same company ever. I started my career at E.F. Hutton. I thought this would be a great place to stay forever. And I think a lot of baby boomers had the attitude that they'd like to stay at their companies, but turned out that wasn't the case. But still, they had that mentality of trying to do better and better and rise within a corporate or business culture. But people have talked about the K economy, the K-shaped economy. I think there's something to that. I think there clearly are higher income and lower income people. There clearly is a situation where it seems like the rich are getting richer and the poor are getting poorer. But I think a lot of that misses the demographics. When I was just starting to get a job, I had no net worth. I wasn't making much. I spent everything I made. And it took a while for me to be making enough to actually start saving. And then I had some luck with a conversion of a condo in New York City. So suddenly I had a few $1,000s extra than I had. And so what the baby boomers have done is they've listened to Spock. Now, I'm not talking about Dr. Spock, because we were babies when Dr. Spock was telling our mothers how to baby us, okay? I'm talking about Spock from Star Trek. And he said, live long and prosper. I mean, in just that simple expression, he's telling us how to get wealthy. Live long and prosper. The baby boomers have been living a long time. And along the way, they bought houses, they bought stocks, they bought mutual funds, they bought insurance policies. They paid off their mortgages, and so they're sitting on $85 trillion. What are they going to do with all that money when they retire? Well, spend as much as you can, because the kids never listened. You didn't like their friends. They never cleaned up their rooms, so the hell with them. You know? Let's just leave them a lot of debt. Let's just keep borrowing. Why do we have a lot of debt? It's theft. We're stealing from our kids. They weren't good kids, so who cares? Okay? You know, we want to live long, so we want Medicare, Medicaid. We want, you know, it doesn't matter what these things cost. Let's just keep ourselves going. Now, I don't think we can spend $85 trillion, and I think I see a lot of evidence around me from my friends, and there are studies that show that there's a lot of trickle down going on between the baby boomers and their young adult kids and their grandchildren. They're helping out with mortgage payments. They're helping out with mortgage down payments as well as monthly payments. They're helping out with the kids, the grandchildren's after-school activities, which are not cheap. And so I think there's a lot of that going on. I got 5 kids, so obviously I should have told you everything about myself, because then you know, oh, Yardeni's an optimist, because, I mean, you have to be an optimist to have 5 kids. You ain't heard nothing yet. To do that, I married 3 times. So you really have to be an optimist to do that. But the 2 youngest ones, only a few years ago, graduated from, one from Quinnipiac, another one from the University of Delaware. When my youngest, Laura, graduated from the University of Delaware, I said, yes, I'm done. No more payments, no more college payments. I'm done. You're off my budget. I said, Dad, not so fast. I didn't get a job yet. I'm still going to live at home until I do get a job. And I may have to stay at home if the job doesn't pay much, which she accurately predicted. And then she decided to move up to Toronto with her boyfriend, who plays lacrosse. He's a professional lacrosse player, on weekends anyways. So he has a real job, and they're both doing extremely well. But there is an affordability crisis, even if you live in Canada. Everything is expensive. And so I agreed when she moved out. I said, okay, you have a really crummy car. I'll get you, not a brand new car, but I'll get you a better car so you can drive up to Canada. I wanted to get the kids out of there. So I had David and Laura living with us. I said, here, you can have, replace your clunkers with not brand new cars, but good used cars. And it worked. It got them out of the house, and they moved. But Laura's an amazing negotiator. She said, Dad, you know, I don't think we can make ends meet on what we're both making. So I said, the nice guy that I am, I said, okay, how about this? For 12 to 24 months, depending how you guys are doing, I'll give you $1,000. And so at the end of a month, so at the end of every month, before the new month even begins, she sends me a text message saying, Dad, can I have my child support? It's like, I'm happily married. Why am I paying child support? Now, I don't know if this might be fun. For those of you who have young adult children, and that looks like a mix of, some of you may be the young adult children that I'm talking about, but you've probably done very well. But I'm not going to ask you to fess up if you're getting help. How many of you who have adult children are helping them out one way or the other? So everybody's going kind of like this. Nobody wants to say, yes, I am, and I'd love to stop doing that. But it does depend on the age of the crowd, but again, I think there's a lot of that going on. So how is it possible, with employment barely growing, with all this student debt, with all of this consumer debt, how is it possible that consumers are still spending? And the answer is the baby boomers. And they're having a great time. My friends who are not working or retiring, they used to go to a cruise maybe once every 5 years. Now they're going to 2 cruises a year. They're eating out all the time. What's the point of cooking at home when it's only the 2 of you? They're going to see doctors all the time just to make sure that they can climb Machu Picchu in Peru next time they go. And they're spending. And they're spending a lot of it. Now, I'm not telling you it's, that everybody's in the baby boomers is doing well. but $85 trillion is a lot. And I think the younger folks are thinking to themselves, I love my mom and my dad, but how much longer are they going to live? The longer they live, the less there's going to be for me. Is it possible that people are actually thinking like that? I don't know. This is, by the way, the same chart showing you the stock market. So my friends on the cruises are texting me, Ed, we don't know what you're doing, if you're helping keeping this market up, but if you are, keep doing it, because we're having a great time on this cruise. Wish you had joined us. We know you get seasick on cruises, but you really must give it a try. And they said to me, we're spending all this money, and I look at my monthly statement, and we keep getting richer. So there's a huge positive net wealth effect from all this. Now, the downside, if something does in fact trip up the market, and you get a really miserable, ugly bear market, maybe they'll all retrench, and maybe that's what causes a recession. But the other reason why the economy's been so resilient is this chart. Capital spending has been absolutely booming. This is inflation-adjusted capital spending in the GDP accounts, absolutely booming. And this is the percent of nominal capital budgets that are spent on technology. It's over 50%, but that's an underestimate. I mean, a machine tool, that's basically technology hardware combined with technology software. I mean, all these pieces of equipment, trucks, are now basically the device that's run by a logistics software. That's not included in this. So there's a lot of technology that really isn't even in here. But technology, I think we have been in a digital revolution since the 1960s. I grew up in Cleveland, so I feel a lot of kinship, and I'm very kind of at home in the Midwest. It's a little calmer, well, until things started to happen in a place like Minneapolis. But generally speaking, people are a little bit less crazy than on the East Coast and the West Coast. But that's just the generalizations from my minimal encounters. So then we moved to California, to San Jose, California. My father joined IBM, and brought home Fortran manuals, programming manuals, so I got a little geeky with all that stuff. But we had the mainframe. That's what IBM made in the mid-1960s, and that was the beginning of the digital revolution. The idea is process as much data as you possibly can, as fast as you possibly can. And we've been doing that. And so in the late 70s, I wrote a PhD dissertation, and it was an econometric dissertation. I'd seen too many of my fellow students try to reinvent, come up with some amazing thesis, and they never finished it. They were called ABDs, all but degrees. I just wanted to get out of there. It was Yale, it was New Haven. The weather is miserable. There were other factors. It wasn't too easy to find a girlfriend, for example. So I just needed to get the hell out of there. And so what I did is I wrote an econometric dissertation that confirmed what my advisor, James Tobin's theories were about how people and businesses manage their activities. And he loved it. He didn't criticize it. I didn't have to rewrite it. And I got out of there. But to do that, I had to go to the mainframe center every single day. And I had to sit there at not a terminal, but a punch card machine. Okay, some people can't imagine this. The younger people can't imagine this. But you actually had to punch cards, little cards, with the data, with the instructions. And then you had to be very careful not to drop it all. And then you brought it to the operator, and the operator said, come back around 3 p.m. the next day. You'd come back, be a stack of paper like this. You'd look at it and say, this is not quite right. Econometrics is, you can tweak it until you get the right t-statistic in R squared. And so you play around with that, but it was laborious. Then we had the mini computer introduced by Digital Equipment. It was a smaller, faster version of mainframes. Then we had the PCs and the laptops. Back in the late 90s, early 2000s, we really had 2 apps. I remember in the late 1990s, I was at Deutsche Bank in New York City, and we went from nobody having a PC to everybody had a PC in their office. And we had about 300 people in the IT department, and these people would bring the box in, they would install the operating system, they would install the software, and then when the software needed to be updated, they'd come back and manually update the software. And there were only 2 apps. There was basically Excel and Word. And if you had a lot of bookkeepers, Excel might increase the productivity of that department. And if you had a lot of secretaries on Selectrics, that might increase productivity. But once it all got kind of implemented, productivity growth really fell significantly. And from that, we went to the cloud. And the cloud was great. Now you can rent software, and it gets automatically updated. And now we have AI. AI is artificial, and it's not intelligent. Okay? Just want everybody to know that. It's a probabilistic statistical model that anticipates. It's kind of like autofill on steroids. You know, you're on Word, and it's telling you, the annoying thing's telling you what the next word should be. This thing just tells you, just keeps yapping away. Sounds really pretty intelligent. I use it every single day as a research assistant. It's almost like, imagine that you hire a research assistant that has a great resume, amazing references, and then you hire them, and you say, damn it, I got to check everything they're doing, you know, because they make mistakes. And that's one of the reasons we're going to need humans to, with some experience, to check what the output is, kind of makes sense. And I don't know that you want to have AI, depend on AI for doing heart surgery, but doing some routine things. So I think all companies today are looking at how AI can improve their productivity. Do they really have to hire? And I think what will turn out is that for a lot of companies, AI is not ready for prime time, but they're going to wait until the next iteration of it. And meanwhile, what they've done is they've looked at their company and said, you know what, we were looking to see whether we could use AI to make this department more efficient. Like, get them all the hell out of here. It's just a waste. They don't contribute anything. So I think there's basically been a freezing of headcount. If you lose somebody, maybe you could replace them. But other than that, the labor market just hasn't grown much. But again, retiring baby boomers are also a factor there. Strict immigration policies and deportations obviously have had an impact. And yet, real GDP is absolutely booming. So why does the Fed feel that they've got to cut interest rates? Well, it makes sense. Let's cut interest rates to stimulate demand so that we need more workers. But the economy's grown 4% in the second and third quarters, and now, bizarrely, it seems to be growing 5%, according to the Atlanta Fed. So real GDP, demand, consumption, capital spending, net exports, inventories, it's booming, absolutely booming, with no growth in the labor force. Productivity, therefore, must be just absolutely flying. So let's see if we can find anything like that here. So this blue line is productivity, and that's the year-over-year percent change. And you can see that we have, in fact, rebounded over the past couple of years from below the average of 2% to above the average of 2%. But with the way the quarterly numbers have been going, and if this is not just a fluke, but it's sustainable, which I believe it is, because it's part of the Roaring 2020s thesis, then I think productivity, instead of growing at 2%, which is sort of the average, back to the average, I think it's going to grow 3 to 4%. And going from 2% to 3 to 4%, 1 to 2 percentage points, is a huge deal because it all goes into real GDP, gives you more growth. It also gives you less inflation. This is the unit labor costs, which is it's hourly compensation divided by productivity. Hourly compensation divided by productivity. So if productivity is growing faster, unit labor costs, inflation is coming down, and that is the underlying inflation rate in the labor markets. And as you can see, it's come down rather substantially. The quarterly is 1.2%, and the headline is CPI is on there as well. But I think we're going to go down to 2%. So I think real GDP could grow 3 to 4% over the remainder of the roaring 2020s. And by the way, I don't think it's going to be the disastrous 2030s. I think we could very well be looking at the roaring 2030s, but we'll see. I mean, we certainly don't want to relive the 1930s, which is a total and complete nightmare. What else can we talk about before we open it up for some conversation? Again, going back to productivity, this is construction of data centers is the red. The blue is construction of office buildings. It's kind of an obvious chart. I mean, it's nice to see what we read in the newspapers and the media that it's corroborated by the data. There's a lot of spending going on data centers. Now, with regards to that, I'm forecasting that the S&P 500 will get to 7,700 by the end of the year. That will be about a 10% increase. I have been bullish on the market since the beginning of the decade. I didn't tell people to get the hell out of the market at the beginning of 2022. I did anticipate a correction. It turned out to be a bear market, but I did in November 2022 say I think that's the bottom, and it's been rocking and rolling ever since, with a little bit of an interruption at the beginning of last year on liberation tariffs. But I also have been very positive on information technology, communication services, industrials, and financials. I tried energy for a while, but it didn't work, so I dropped it as an overweight. But late last year, I said, you know what? What's going on with the Magnificent Seven is kind of like Game of Thrones. It's like 7 kingdoms that are very powerful. They're surrounded by moats, and they just want to be left alone because they got their own monopolies. They're doing absolutely fine. They have no ambitions to attack each other. But then AI comes along, and they're all spending suddenly a tremendous amount of money on data centers. They're all starting to figure out that they can use AI to basically get into each other's businesses. And it just creates a lot of competition that the Magnificent Seven didn't have. So I went from overweighting Magnificent Seven to underweighting Magnificent Seven and recommending overweighting the impressive 493, because clearly all these technologies that the Magnificent Seven are selling have to be sold to somebody. And the only reason that people are going to buy it is if it has some real value. And in this case, it's the value of increasing productivity. So I recommended, I also looked at the market cap share of technology and communication services relative to the S&P 500 market cap share, and said, you know, this has worked out all too well for us. It's 45% of the market cap of the S&P 500 is currently around is around 45%. Do I really feel comfortable telling people to overweight IT and communication services when they're already 45%? Am I telling people to go 50, 60, 70%? I don't think so. And so I pulled back and said, I just want to be market weight those two, and the whatever rebalancing I'm doing, I put more money into the financials, which we've overweighted, and into the industrials. And so that's where we still would be. It doesn't mean that you get out of tech. It means maybe more in semiconductors, maybe not in NVIDIA, because that's one of the 7, but it is facing more competition from other technology companies that see an opportunity. Look, the problem is all these hyperscalers may build all these data centers paying premium prices for chips today that a year from now could be replaced by new chips that are cheaper, cooler, don't need as much electricity. I mean, technology solves problems. And right now, the problem is so bizarre that Google's actually talking about, and I think they're actually going to do this. They're going to try to establish a data center in outer space. I mean, really, do we have to go that far? So I think somebody's going to come up with technologies that make what we have now almost obsolete. So again, that kind of makes you wonder how profitable is all this spending going to be? Don't get me wrong, these are still magnificent 7 companies, but I think they're going to face more challenges. And the old model was, let's not spend very much money on capital, on labor. Let's just sell our advertising services, our search services to as many people as possible, make a tremendous amount of money, have a tremendous amount of cash flow, and buy back our shares. And so we're seeing less of that. Let me spend another 3-4 hours with you. It's actually only 7, and we got another hour, so we can have a lot of fun in a conversation if you like. So this is the consumer, and people say, oh my God, did you see this chart? Disposable income starting to go flat. You know, how is the consumer going to keep spending if disposable income's going flat? And the answer is $85 trillion. That's how. In other words, the baby boomers are retiring. Guess what? They make a lot of money, and suddenly they're not going to get paychecks. So naturally, disposable income is going to go flat. We're not saying an increase in the any significant increase in the head count of employees. So if you're not going to have more consumers, what's going to keep the consumer spending? And again, $85 trillion will keep it going for a little while. And then I think productivity does, in fact, have a history of trickling down to the purchasing power of workers. Real wages will, in fact, do better. In some ways, this is the big risk I'm taking here on the roaring 2020s. What if consumers say, well, it's fine for the baby boomers, but real wages for everybody else is flattened out. We really can't afford to keep spending, and the consumer just retrenches. I think it would take a bear market in stocks for the consumers to really retrench. And we can discuss, what could go wrong in a few minutes here. Let's see. Oh, yeah, this is productivity versus inflation-adjusted compensation. There is a little bit of a gap between the two, but generally speaking, productivity drives the standard of living. We looked at that. Kind of a couple of loose ends here. We talked about the stock market. We didn't fully talk about the market. I think the market's going to 10,000 by the end of the roaring 2020s. And we'll look at that in a second. But with regards to the dollar, I'm not bearish on the dollar. I mean, really? I mean, America's still got the premier capital market. If you look at the monthly data that the Treasury puts out, foreigners are buying equities at a record $700 billion over the past 12 months, all-time record high. They bought something like $900 billion worth of fixed income securities. I understand that stablecoin has really taken off in emerging economies, and a lot of stablecoin is backed by U.S. Treasuries. And so there's a lot of demand for our securities by foreigners. And so I'm not particularly bearish on the dollar. I'm not going to tell you it's going to go straight up. Besides, this index is really, this DXY is 57% the euro, and I don't quite understand what's so exciting about the euro. But I'm looking at it technically, and I guess everybody will panic when it goes below the line, and I'll say, don't worry, be happy. It's not the end of the world. Gold. I never had an opinion on gold whatsoever. I'm an old-fashioned strategist. I need dividends, I need earnings, I need rent, I need something to value, to take a present discounted value. And I don't have that with gold. But when it crossed above $2,000 an ounce last year, no, the year before that, 2024, I said, I think we're in a bull market. And I said, it's real simple. Russia invaded Ukraine. We froze Russia's assets, and foreign central banks, particularly in countries that don't get along with us, they're not going to want to have the same thing happen to them. so they're going to buy gold. That's simple. It worked great. Got to 3,000 at the beginning of last year. And then when it got to 3,000, I went back and did some I'm an amateur technician. I have a ruler and a pencil. And I said, hey, there's a channel here, and it could take us to 4,000 by the end of 2025. And it seemed delusional at the time, but it got over 4,000, I think to 4,500. And that's kind of where we are right now. So when it crossed 4,000, I raised my target for this year from 5,000 to 6,000. And I think gold could get to 10,000 by the end of the decade. And, you know, I mean, you can say whatever you want about gold, about Bitcoin, anything that, you know, any asset that doesn't generate any income, you can, you know, say it's going to go to 1 million or it's going to go to 0. So, you know, in what world does gold go to 10,000? Well, Chinese investors got destroyed in their property market. They got whipsawed around in their stock market. And so Chinese investors are looking at gold and say, this thing goes up every day, and every now and then it gives you a day or two where you can buy it. And so I think Chinese investors are buying it. Maybe Iranians are buying it. The Indians have always bought it. Americans are buying it. I think what is extraordinary about our world today is wealth has never been greater. It's not just the baby boomers. We've never had more wealth. And you guys are all wealth managers, and it's been a great business. And as long as wealth keeps growing, there'll be a need to invest. There'll be a need to diversify investments. Rich people, wealthy people are conservative. And I've had, I work, our research, a lot of our subscribers are wealth managers. And over the past couple of years, they've been telling me, Ed, you know, it's hard keeping my accounts invested in stocks. They don't feel comfortable with it. I said, they're making all this money. What's to feel uncomfortable about? I said, what are they worrying about? And they all tell me they're worrying about the U.S. government debt. So I said, all right, so what do they want you to do? They want you to get out of equities. What do they want you to buy? He said, 10-year treasuries. I said, oh, okay. So there's a lot of diversification that means there is demand for bonds, there is demand for gold. And if you look at gold versus the stock market, the S&P 500, on exactly the same scale, one is an index, one is dollars, they're kind of inversely correlated, which means gold really is a great diversifier for a stock portfolio. But if you look at the trend, if the S&P 500 gets to 10,000, then gold can get to 10,000. So how do we get to 10,000 in the S&P 500? You just have to trust me. So this is the valuation multiple. You'll notice that we're around 22, which is where we were right after the lockdown recession. So for all practical purposes, the PE today, not practical purposes, the PE is back to where it was back then, and yet the market is up 100%. So earnings have been up 100%. So it has been an earnings-led melt-up, and the question is, yeah, but the valuation multiple is too high. And my thinking on that is maybe investors have come around to our way of thinking that the economy is resilient, that it can take these shocks, it can continue to grow, and if the economy is resilient, earnings are resilient, and so it all works out pretty well. I've observed, again, that valuation multiples go down when people fear a recession and you don't get it, so then they go right back up. Or you get an actual recession, in which case the PE and earnings go down and you get a bear market. So this doesn't come with a money-back guarantee, but based on the experiences we've had, I think arguing that there may not be a recession over the rest of the decade has some credibility. Maybe it doesn't say, well, you know, because we haven't had a recession for so long, we're overdue to have one. But I've been arguing we have these rolling recessions that hit different industries at different times, and yet other sectors more than offset that. So we're looking at earnings per share here, and again, no recession here. So looks to me like last year's going to come in at $268 a share for the S&P 500, if you look at the legend box. Then we're using 310 for this year, then 350, 400, 450, 500. As you can tell, this is based on amazing science and statistical work. Again, trust me, if we don't have a recession, I think these are perfectly likely kind of numbers to generate. And every single week, we monitor what the analysts are thinking, and the analysts are even more delusional than we are. As you can see, the 2027 number is actually going up. They're getting more optimistic about the future. But when I do PE times Z, I do forward PE times forward E. So I'm kind of forecasting the forecast. What are analysts going to think that earnings will be at the end of 2029? And I'm thinking they could be looking at $500 a share times a multiple of 20, and you get to 10,000. So that's the amazingly rigorous science behind all this. So, we get that kind of, with a 22 multiple, you get higher than that. So this is the kind of ranges I see. And and because I had a happy childhood, I picked the top of those ranges as where the market's going to go. And if I'm wrong and the market goes down, I've got some cushion to say, see, I left some room here, but not much because I'm using an 18 multiple for the downside. It's not, if we have a recession, the multiple is going to go under 15. And that's it. Just to prove that I am balanced, I love people like David Rosenberg. I love the perma bears. They save me a lot of time, because they think about everything that could possibly go wrong. And so I don't have to work as hard. I just like, all right, what did they miss here? What else could go wrong? And for the life of me, I can't figure out what else could go wrong that they haven't thought about. And there's some very powerful, influential people. Ray Dalio has been depressing the hell out of everybody, saying there's an imminent debt crisis out there, which really pisses me off, okay? Why is a billionaire telling the rest of us to be cautious, okay? I mean, how did he get to be a billionaire if not taking some pretty crazy risk? And by the way, I've been doing this for over 45 years, and back in the 1980s, I came up with the phrase bond vigilantes, and I said, if the monetary and fiscal sheriffs don't maintain law and order, the bond vigilantes will do it. And so I figured the bond vigilantes was kind of a protest every now and then when the debt was too much. And my position has been, I'll worry about the debt when the bond vigilantes will worry about it. And right now they don't seem to be terribly worried about it. So Ray's been telling us that the debt crisis is imminent, and I don't think it is, especially now that we got this new gimmick stablecoin that can be backed up by T-bills. And by the way, Janet Yellen, the bond vigilantes are not the only players in the market. Basically, Ray's counting on the bond vigilantes to protest and to shoot the bond yield up to 6%. The stock market crashes, and we get a crisis and all that. But the bond vigilantes are not the only players in the game. There's also the Fed, there's the Treasury, there's foreign investors. There's a lot of players there. And Janet Yellen was faced with a debt crisis in 2023. I did worry about a debt crisis in 2023. The bond yield went up from 4 to 5% in 3 months. And Ackman made a fortune by being short the bond market. It was a brilliant trade. But he got out on November 1st, and just by coincidence, Janet Yellen basically announced that if the bond vigilantes really did want to take care of the extra financing that she needed, she'll do it in the T-bill market. And at the end of the day, Besant could say, I'll do the whole thing in the T-bill market. And so, I'll worry about it when they worry about it. What could go wrong? I mean, Trump is obviously being quite aggressive with the Monroe Doctrine, the Trump corollary of the Monroe Doctrine. with regards to Latin America, Venezuela, I guess Cuba, Greenland. I mean, what a crazy world. I'm reading a story this morning about NATO is doing a military exercise in Greenland, and they're not inviting us. It's like, what? You know, we're going to be like attacking NATO? I mean, it's really bizarre kind of stuff. But you know, if there's a Trump doctrine here, there's who's to say there isn't a Z doctrine? I think Z is like 89 years old, and he must be getting advice from the hardliners. This is your chance. I mean, the justification's pretty obvious. If Trump's going to take charge of his sphere of influence, then we need to assert our domain over the South China Sea and Taiwan. And so that could obviously get real ugly. And you know, the stock market will take a huge dive on that situation. I guess the consumer could retrench on us. I don't think that's a big risk. The bond vigilantes could act up. I don't think that's a big risk. So I think a lot of the risks are geopolitical. I mean, the Putin doctrine was laid out 6 months before he attacked Ukraine. He basically said, you know, most of Europe is ours. He said it's certainly any country with Russian speakers is ours, and the other ones will teach them how to speak Russian. So it's clearly a dangerous world. That's another reason why gold is doing so well. So it's not as though there aren't things to worry about. With that, are we doing a little Q&A?
We'll take some Q&A if anybody wants to come up to the microphone. Maybe I'll get it started. And you're bullish on gold. Do you have an opinion on silver and copper?
Look, I think it's pretty clear that we're talking about precious metals as an asset class that's doing extremely well. I mean, I was around during the Hunt silver crisis in the early 80s, and silver went straight up because the Hunt brothers were cornering the market, and that trade didn't work out too well for them, so they had to panic out of it, and so silver took a big dive. I am kind of wondering, whenever you think, you know, we've all been in this for a while, and whenever you see something going straight up, you have to start worrying that, you know, history shows that something crazy is driving it up, and when that's kind of revealed, it just takes a huge plunge. So that could happen to silver, and that could create a buying opportunity in gold. But it could also be that a lot of it is related to the perception that AI infrastructure requires a lot of metals, particularly silver. Copper's also had a huge move here. I mean, at this point, I wouldn't tell people to jump aboard. I would say, you know, there probably will be another opportunity to get on the rocket ship here in precious metals. But again, I don't feel that comfortable with precious metals because I can't really figure out I can't value the damn thing. All I can do is kind of look at how it's trading. It's very, very technical. Bitcoin is kind of the same thing. And Bitcoin last July lost one of its functions. It was supposed to be a means of a media of exchange of transactions, but it's too volatile for that. And meanwhile, stablecoin, which was passed as part of which was regulated and legitimized as part of the Genius Act of July of last year. Now, whenever they name something a Genius Act, I get really, really concerned. So, you know, I mean, we have vulnerabilities here without a doubt, but it's conceivable that we have a bunch of bubbles, and some of them will burst, but it won't be the kind of effect that we had with the tech bubble bursting in 2000 and the housing bubble bursting. Remember, people were saying that we got a bubble in SPACs. Well, that kind of burst without any real repercussions to the economy. We had a bubble in office buildings. Well, we had too many office buildings, and especially after the pandemic. And we've had a depression in downtown old office buildings, and yet that hasn't caused any real calamity. So there is a resilience of the economy that can maybe have multiple bubbles that don't burst at the same time and correct that way. The same thing with a recession. Instead of a recession, we have rolling recessions. I came up with that term back in 1985 when oil prices collapsed and Texas and Oklahoma collapsed with it, and people were worried it would cause a national recession. I said this could probably just be a local rolling recession.
So you said you were up in Iowa. Now investors have the opportunity for fractional ownership in farmland. What do you think about that?
Well, after I listened to some of the speakers, I called up my wife and I said, honey, you know, we got 4 acres here in Long Island, and we've tried to raise some corn in the garden. I haven't really succeeded with that. And I'm so excited about farmland that I think we should put our house up for sale and buy 1,000 acres out here somewhere around Des Moines. And she said, have you lost your mind? So we're not going to do it. She won't let me do it. You know, happy wife, happy life. So she didn't take to it at all. But there's a company there called People's Company that apparently was a savings bank at one time that morphed into an intermediary between farmers and investors in farmland. And they have this annual conference. And they made a pretty persuasive case that farmland, ranches are a very interesting asset class. So, but of course it's illiquid and it requires management, and there are issues there. But I was kidding. I'm not ready to be a farmer. I'm not ready to buy it as an investment because you got to buy a few acres to make it work.
Hi, I'm from Olin Business School from WashU. Shout out to WashU. I have a question. You quoted kind of like 4% in growth rate in terms of GDP for U.S.
Can you speak up a little bit?
You kind of quote, like, there were some, like, quotes. I mean, I agree with you that S&P will grow in 2006. I guess, like, my question is, like, you quoted 4% in GDP for U.S., but there's a lot of economists that quote that there's, like, a K-shaped growth where, you know, there's, like, an elimination of middle class. And you know, a lot of the policies that's adopted by the Federal Reserve probably is going to be catering towards more of the mass, like, population in the U.S. I guess my question is, like, how much of, like, let's say for assumption, like, the next, you know, the chair of, like, you know, the Federal Reserve is very favorable towards the Trump administration and does massive QE. But then, you know, the Japanese Prime Minister actually announced last month that she actually said in English, shut up and invest in me. And they are also very dedicated to increase their interest rate and suck in a lot of the money internationally in terms of investment. So I guess, like, my question is, even though you do think there is, like, a growth in, you know, growth in the index of S&P, like, how do you think all these, like, kind of like geopolitical nuances and other international, like, you know, government policies is actually going to affect? And
Right.
yeah, and also, sorry, one other thing. You also mentioned that the baby boomers, like, you kind of like quoted that this amount of money is actually the net worth of baby boomers. I guess all of my other question is, like, how much of that asset is actually, like, a liquidated asset? Because, like, a lot of my parents are kind of like baby boomers, but the trend I see is that our parents' generation is not spending any of their cash because a lot of their asset is held towards, you know, real estate, you know, which chunk of their money is, and
Yeah.
they're so dedicated to pass on to that real estate to their children, so they don't really actually have a liquid kind of asset to actually invest in anything.
Sure.
So, so I guess like my question is like, do you have any kind of like comments on those kind of stuff?
Sure.
I mean, sorry, yeah.
Sure. Well, thank you, everybody. Reschedule yourself. We'll need another 2 hours to answer that, but they're really, really good questions. I wish you hadn't asked me about the Fed. I get very emotional about it. For many years now, on several occasions, I've put this in writing. I said, I will do what the Fed does for half the price, okay? As long as they let me do it from my home office, and I don't really have to go down to Washington. I think I, along with my staff, can run Fed policy as well as all those people. And the Fed has 300 PhD economists. I think I can do it. But they never took me up on my offer. And I didn't even make the short list on potential Fed chairs. I wrote a book a few years ago called Fed Watching for Fun and Profits. Maybe that was too cutesy a title, so it wasn't taken seriously. But I think I did a pretty good job of trying to explain to people how important the Fed is in investment thinking and how important the Fed chair is in that process. So I've studied a lot about how influential and powerful Fed chairs are in terms of getting a consensus. I think that Trump has poisoned the well here with going after Powell with this investigation, because no matter who the next Fed chair that he picks, it's possible that the Senate will say, you know, we told you to stop harassing Powell. He's going to be gone anyways in May. I think what they may want to do is make him just go away completely, because after May, he's still governor until 2028. And maybe he was thinking about retiring, and now he's going to say, hell no, I'm not going to retire. I'm going to, get these people pissed off as much as I can on a regular basis. I mean, we could in theory have a situation where the Senate does accept a Trump chair, but that chair is viewed as Trump dependent, while everybody else at the Fed is data dependent. And we could have a situation like Steve Moran. Let's say that suddenly out of the blue he becomes Fed chair. And by the way, one of his assistants worked for me for a year, so I trained him. So I don't know if you can talk any sense into him, but Moran wants to cut the Fed funds rate by 150 basis points. I could see a situation where if he was Fed chair, he would be the lone dissenter, and he would be wrong. He wouldn't be part of the consensus, which obviously would kind of raise doubts about the importance of the Fed chair in that kind of situation. But I have withdrawn my offer to be a Fed chair because I don't want to be investigated. I think there's something to be said that I'm clean, but if they can put all of us away if they turned all their energies on us and found something or planted something to get at us. So I'm happy doing what I'm doing, and I no longer aspire to be Fed chair. But I think the Fed is going to be more independent, ironically. And if that's the case, I think the data is going to come across as not requiring any more rate cuts. They've cut 175 basis points. I don't think there's a need to cut any more. What's the point of cutting rates? To stimulate demand, to get more people employed? Well, the economy is booming and we're not hiring more people, so maybe the problem in the labor market are somewhat structural. With regards to your question about the baby boomers, yeah, I mean, there are different strokes for different folks. Obviously, there's different experiences. Some people, baby boomers, may have most of their wealth in a liquid kind of securities, and so when they pass away, if they leave anything to you, maybe you have other brothers and sisters that they'd rather leave it to, or if they leave it all to you, you'll probably just wind up selling it, or the family will wind up selling it. So $85 trillion is a lot of money, and it's, as I showed you before, a good chunk of that is in stocks. I have on the website, Yardeni.com, I have chart books on it. They're open to the public, and you can see all the different assets that they hold. Any other questions?
Yeah, I have a question. My question is a practical one, because you talked about generational wealth transfer. That reminded me of a scene from the TV show Billions. This guy was announcing to his...
I'm sorry, you're going to have to speak a little louder.
I think, because you talked about generational wealth transfer, that reminded me of a scene from the TV show Billions. And this guy was announcing to his buddies, because he just inherited $5 million. And he was elated, and his buddies like, oh, no, man, that's the worst. Because that's not enough for you to retire, but that's enough for you to hate your job. So I guess my question for you is, what would be your advice for someone, a young folk who just inherited $5 million, let's say?
Well, again, you folks are getting awfully specific about it. And once you do that, I start charging an hourly rate, once I give individual advice. But look, I think that I wouldn't be surprised if it dawns on the younger generation that they are going to get a sizable inheritance. As a matter of fact, some of my baby boom friends have had their parents passing away over the past few years, and they've gotten sizable inheritances from that. So it's already started with the previous generations. So I think that continues. I mentioned before that disposable income could very well go flat here as the baby boomers retire. I'll give you one more kind of outside-the-box thought, and that is the personal savings rate could go negative, right? Because if all these baby boomers are consuming, but their income, without income, maybe they have some income from their assets, but they don't have the 100,000 whatever they were making in paychecks, then the savings rate could very well go negative. And if the younger folks are kind of living to paycheck plus the child support for me to keep them going to the end of the month, they're going to be spending it all. And that empirically, I think, is how the economy is performing. Thank you. Let me, I'm an entrepreneurial capitalist. I've got my own little company. It's a proprietorship. There are 30 million proprietorships in America. So I think that entrepreneurial capitalism is what makes America truly great. And I think we've recently seen applications for to start a business have absolutely soared. So I'm counting on a lot of Americans to reinvent themselves with all these challenges. I think a lot of Americans are going to business for themselves. But I don't really care about them. All I care about is me. And I want my business to grow. So go have a look at Yardeni.com. Try the research. We have it for institutions and individuals, kind of separate tranches. And make Ed Yardeni richer again. Thank you.